Stocks started the day to the downside with a opening gap, which hasn't been too common lately, but filled that gap throughout the day, closed near the high. But the question now is, was today's lower low and potentially a higher or lower high the beginnings of this intermediate drop that we've been looking for, and how long will it take for that to happen? So in today's video, I'm going to break down some of the signs that we're seeing that shows we're actually kind of been in a little bit of a risk off mode here lately. Some of those technical signs, even with the S&P rallying, I'm going to break that down and how long and what the process of convergence and pullback looks like and what to expect. Does it all happen in one day? Is it, what are the things that we need to see to say we are definitely now in this intermediate draw? So I'm going to break that down and take a look at our trade idea of the day on a stock that was on its own little pullback before a nice little reversal that completely reversed a drawdown, a pullback in one day, and how we trade that. So let's go ahead and get started. Today is Thursday, January the 23rd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we had a pretty decent intraday low point, but rallied and closed the day at the high. That's why the candle's not filled in there, and the long lower shadow is our intraday low. The lower shadow was enough to keep the near-term line down again for a second day. The momentum line bounced up with the close near the high of today's range, a relatively bigger range than average here, our really low average. Of course, the intermediate posture is still strongly bullish. The intermediate line or long-term market sentiment is still strongly bullish. 3.5 months now going in to, or getting close to 3.5 months. I'm going to venture to guess by the time this intermediate posture, the intermediate line drops below 50, we'll have at least 4 months, which would be towards the middle of February. Now, it doesn't mean that it might start dropping towards 50 before then, but I'm going to say at least by the middle of February, by the time the intermediate line falls below 50, if not longer than that. Remember, this is the beginning of a long-term run. The first move on a big long-term run tends to be bigger moves, right? So 4 months is not out of the realm of possibility. We don't want it to go too long, as we saw in January of 18 when it went 5 months. It can get pretty bad. But I do think this is very similar to the move we saw in January 17 when we were coming up off of those late 2016 lows around the election. We had a 4-month rally there. That run actually ended with the January 18 5-month rally. So, and a couple of intermediate runs in between. So that had 4 intermediate runs on that particular, with the one that started it with 4 months and then the one that ended it with 5. And that's very typical to have longer runs there. So I believe this is the beginning of a long-term run that we're now, over 3 months into. So it's not like we're right at the beginning. But, it's a nice, good move. This near-term line, we've had a couple good long near-term runs here where the near-term line ran up above 50 for that more towards the long end of the typical 7 to 12 day range. Now that we're getting longer in, start looking for more shorter runs, similar to what we saw right here, where you start getting some choppiness, some shorter near-term moves to the upside that don't last 7 to 12 days. Of course, you also need to get up above 80. That's 7 to 12 days plus a move up above 80 is kind of what you need to see from a bullish standpoint. 1 to 3 days with a move not getting below 20 is what you need to see on the decline. So we pretty much had that, barring this one little toe dip here below 20. Other than that, we've been getting progressively bullish near-term lows, and we've been getting some pretty decent near-term highs too. Now the question is, because of the maturity of the intermediate run, whether or not we're going to continue to get these nice long near-term rallies that last a couple of weeks, essentially last a couple of weeks. I don't think so. I think the odds of that, of course, nothing's ever 0 or 100%. I think the odds of us getting that are getting closer towards 0, are much lower. So start looking for choppiness. That the intermediate posture will, before it really declines, especially when you have big long ones like this, if I were to go back to that time frame here, if I were to zoom in, bear with me 1 second, I don't think I have this. There we go. If I were to zoom in here and go back to even this near-term, this intermediate rally that we had, you can see how the near-term runs started. We had good, nice, long near-term rallies, and then they got choppier. This was a pretty decent one that had a cluster in it, and that was about the longest one, but that was probably 7 days. You see how they got shorter and choppier. They were still relatively bullish. They just didn't last very long, and the lows were still relatively bullish. They just got shorter and choppier, and eventually that's when the intermediate run ended. When we stopped getting above 80 on the near-term rally. That started this last market sentiment run. Back over here, coming off that November, this was the November, this is the 5-month rally. Again, this is the idea of when it when it could have ended. After that, you see all this choppiness, and then we had this last big hurrah. Before that, this was that run that, again, kind of like this last month of hurrah. Before that, you got some choppiness. So I don't think we're going to get like a 5th month of just rallying. We don't have anything like tax reform or trade bill that we're anticipating to extend us out a month. So expect choppiness like we saw before, like we saw over here, where you just start getting choppy. Notice we don't go down. It just gets choppier, more red days in there, more up and downs on the near-term line, and then eventually we grind our way towards zero. And I expect something similar to happen here, and that could take a few weeks for that to happen and still have an upward bias. It hasn't started to happen yet, so that's why I still think we have at least 4 months on this intermediate run before we start pulling back. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube that notifies you when these videos are posted. Hit the thumbs up icon down below the video. That tells us you want us to do the video again tomorrow. Quick, easy way to give us feedback. And then comment down below on anything that stood out to you today. Join our website at marketscholars.com. There's a link popping up right there in the top right corner of your screen. Click on that link to go subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. One of the most highly requested things we get with these Market Outlook videos is that we follow up on past trade ideas, and we can't really do that in these videos because we come out with a new one every day, but we do have a product here at Market Scholars, our Market Outlook Live. We're at 3:30 Eastern Time. If you click on this, it takes you to that page. But at 3:30 Eastern Time, we go through and we look at all the prior trades that we currently have. You can see we do it on Monday, Wednesday, and Fridays at 3:30. We have all the old archives there as well. And then you can watch the current video here, and even during the live video, it's done live at 3:30 Eastern Time. You can chat with other people over here on the right. So every Monday, Thursday, and Friday, we do these Market Outlook Lives at 3:30. We follow up on all the trades, and we put on today's trade idea before the market closes. So usually by the time you watch this on YouTube in the evening, we've already done the trade, so we don't have to worry about trying to get in the next morning. We also invite you to engage with us on social media. Click on that heart. It opens up this window. You can like today's Market Outlook tweet there. Sorry about that. You can also click on it and it takes you there. You can like it there. You can also click on this. That will take you to our Facebook page, and you can like the Market Outlook Facebook post as well. All right, if we take a look at the long-term view here, you can see that, good strong bullish candle. We got high momentum. We are not closing above last week's high point on the Heikin-Ashi basis. So I'm more than likely, and you can see how that happens. You get a really good bullish breakout like we did last week. Before you get the transition and the intermediate pullback, you'll have a few weeks where we don't close above the prior week's high. And they get progressively smaller, unlike that euphoric where it was like every week closing above. That was euphoric. Everything else, here's a big breakout week, and then we never close above that high again. So here's a big breakout week last week. Now the question is, are we going to not close above that high? And so far this week, we haven't. We got a new high, and so I expect that we'll probably get a few of these types of weeks before we get the transition. Remember, by the time we get the transition, we've reversed. The the candle here is a good confirmation of that reversal, but we've pretty much reversed by the time we get these little transition candles here to the downside. And then we usually get a few weeks of bearishness before we, even just a couple here, before we start a new bullish intermediate trend. So that's where we're at right now on that. From a 3 green arrow standpoint, you know, again, we've had a good little divergence on the MACD when you look at it on this basis. The MACD has gone up, but now we've kind of peaked and we're starting to converge again. We're still above the moving average, but once you get below the moving average, that's when the convergence really starts. See it again going back. Let's go back a couple years here and going back to right here. Remember, this is where we got all those really short, choppy near-term runs. Well, that's where the near-term line got, the MACD got below its moving average, and it was still at high levels. The average was still pretty high before we started to fall over. So, you know, that's kind of what I expect here, where we'll kind of meander just under that moving average, but still be at relatively high levels while we converge before these lines come together. We get, you know, these, you can see how they were coming together here. The MACD was coming down. By the time we crossed that 30-day moving average, we had been converging for a while. Especially the average, you can see the average had been coming down by the time we rolled over. And even over here, the average started to come down by the time we finally broke that 30-day moving average. So watch for that pattern. Watch for this average to roll over as we converge before we really get the break in that beginning of that intermediate pullback. The intraday chart, you can see that we started off with a gap. Whoops, not that one. Here we go. We started off with a gap and filled that gap in the afternoon. We still haven't filled in this gap, and that's the gap to kind of keep an eye on in the next little bit in terms of near-term runs. Because you notice here, we did get down to a little lower low than what we've had previously. And as of right now, and if we were to hit our head up against this little resistance area, this volume node as a resistance area, then that would be a lower high point. So the next significant level of support to the downside would be down to this node around 328, just under 328. So kind of keep an eye on that node in the next day, if not tomorrow, into early next week, on any kind of intermediate pullback we get. You can see the volume's been still relatively light. In fact, if you take a look at the volume today, is 52 million, and the trading range, however, was pretty big, 2.76 points. Again, that's not really big. It's still below 1%, so it's not, when I say 1%, I mean 1% of the actual price. But obviously for the ATR, give it a second here to load up. There we go. For the ATR, for this to start rising, obviously you need bigger ranges. And today is a 2.76, so it's like right here. But you can see we're so far into the 1% mark. And when you get above the 1% mark, that's your intermediate pullbacks. And we're not anywhere close to that. We obviously have to have 1% moves up or down to be able to spark that pullback. In fact, here, sorry, it is this one. Give it a second to load. You can see when you start getting the pullbacks, you can see we start like into this point, we're getting close to 1% move. We got a 1% drop. We got a 1% rally, pretty close to 1% rally right there. But we got a 1% drop, and then that sparked the intermediate pullback. Over here, here's our 1% drop that we finally got. It was 1.08%. And then that was our intermediate pullback. Over here, we didn't quite get until right there, and that sparked a brief little intermediate pullback at that point. And you can see, too, you also get 1% bounces eventually to the upside. Excuse me. In this case, we had a 2% drop and ended up with a 2% rally that kick-started the move up after the low point was developed there. So we don't have that yet, and this is on SPX. If you look at SPY, we haven't had a 1% drop since October. Since this intermediate rally started, we haven't had a 1% drop. So you're not going to start an intermediate pullback without one. Even over here, you had more than a 0.5% decline. That was kind of like the end of the run there. And over here, you had a 0.5% decline right at this point, and that kind of sparked the end of the run. We had a little bit longer to go before we had the 1% drop. But you get the idea. We've had 0.5% pullback. We were down 0.75% there on that day on January the 3rd, so coming out of the new year. But since then, we haven't had. And obviously that didn't spark an intermediate pullback. So we need to kind of watch that next 0.5% drop to the downside at the very least. You can also see too, we got a pretty decent sized gap forming now. Not as big as it was over here, but you got a pretty decent sized gap forming between implied and historical volatility. Kind of gives you an idea of what we need to see before we even consider the intermediate line dropping below 50. Obviously, volatility jumped up today with that gap to the downside, and as it almost always does, volatility drops throughout the day. So ended up with a long upper shadow. So again, probably not going to get a jump in volatility tomorrow or even Monday. It might take a little bit of time as we grind back down to the downside. But there's no threat of, we're not going to fall off a cliff up here. We're not really jumping to the upside. Let me go back over here really quick. A lot of people talk about or compare this move to January 2018. Let me give you an idea of what January 2018 looked like here. If I were to zoom in and then come all the way out, here's October of 18, so right in here. So if you can see, when we started to go up in January, we had multiple days of 50% gains or more and hardly any kind of a loss. And then we culminated that with a big 1% jump to the upside. That was kind of our blow off top at that point. Well, you look at now and we're like, okay, we've had a few 0.5% gains to the upside or more, but nothing too significant. We haven't really had a blow off top type move yet. So we're not nearly as euphoric right now as we were back over here. And this way you can kind of see how they kind of built up next to each other. It was like day after day after day to the upside. So we're not getting that. Well, it's pretty bullish, but it's typical of a grind now, as we typically get the end of an intermediate run. And so expect that grind to continue until we get some signs that this intermediate pullback is going to be beginning. MACD falling below its moving average, 1% drops, 1% trading ranges or higher. That's about 3 points or more of trading ranges, those kinds of things. You see the VIX as well. You'll see the VIX start moving its way up and trending higher. If I look at it with like a MACD and stochastics, you can see, this is a pretty decent move on volatility. We haven't seen this kind of jump for a while. But now it's a question of where are we going to bottom out. We filled in that gap. Are we going to bottom out back down here or even lower? If we do, we'll take another week or two before we start to get that intermediate line dropping to where we get another new low point, more of a pullback than just the blue line on the market forecast dropping below 50. So what do you think with that assessment? So strong bullish posture, looking for signs of weakness. We've had a few signs of weakness, but nothing that says an intermediate pullback is imminent. But obviously we are a mature run, so there's going to be one forthcoming. What do you think of that? Do you agree with that technical outlook? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Hit either agree or disagree. And let us know down in the comments section below. Again, this idea of a bullish posture that's mature, bullish intermediate posture that's mature, this expectation of near-term choppiness and ups and downs and a week or two of convergence, that gives you a period of time to de-risk, right? Again, like I said before, we shouldn't be more bullish now than we were a couple of months ago. And we should have more risk on the table for the directional move that we've had over the couple of months versus now when the odds of a pullback, if not 100%, are starting to get closer to 100%. And we don't want to lose more during a short little pullback than what we made during this 4-month intermediate run because we were not very bullish at the beginning of it and we tried to catch up at the end of it only to get caught more one-sided on the market than we should be and burn because of it. So again, like I said, let me know in the comment section if either you're more bullish or more bearish than I am with what we came up with our outlook here today. All right, now let's talk about what's driving the price action here today. And we'll just look at just the chart for today alone and see what's going on. You can see long-term bonds and real estate both finished the move to the finished today to the upside. So kind of a risk-off day when you also include the dollar and gold outperformed. On the other end of the spectrum, crude oil stayed down, and so did emerging markets. If you take a look at crude oil has been having a really bearish run. In fact, it's kind of starting a bearish posture on the market forecast indicator. We've had 2 consecutive oversold clusters. Now, whenever you get the oversold clusters right off the bat like this, when the intermediate posture turns bearish, that can set a low point. So, kind of keep if I were to go back to give you some context on this, you can see the clusters over here set the low point. The cluster here set the low point, and these clusters could set the low point. But if you look at over here, we had a cluster and it didn't set the low point. We continued down and down and down and down and down. We had the death cross in the broad market as a whole. And on other instances here, when we were at a bullish market, a golden cross environment in equities, the cluster set the low point there. Come back over in this direction, you can see we were in 17, early part of 17, we were relatively bearish, but even those clusters set intermediate low points before rallying back to the upside. So are we going to set a low point here? Very well could set a low point and start to trend higher, and it would be, the last intermediate low point was down here at the 62% retracement level, and this one's up around 55 or above. So it would be a higher low point for crude oil than what we've seen. So keep that in mind. And of course, this big chunk of this is what's going on in China, and before that, and then the Iran bombing, of course, that occurred. So there's a couple of reasons why we've had these, and usually that's what leads to these clusters, is when you have these kind of temporary geopolitical shocks, so to speak. The reality is, economic growth expectations have been down, and they're kind of in the process of bottoming. So you would expect crude oil to not be in a bear market, because we don't expect equities to be in a bear market. We don't expect the dollar to be in a bullish market. In fact, if you take a look at the dollar, it had a pretty decent, strong upside move today. Now it's just a matter of whether or not it can hold this upside move, and if this near-term divergence plays out instead and reverse our way back to the downside. Of course, a bullish dollar would be bearish for crude oil, but that's not the expectation there. The other market to kind of consider is the 10-year yield, as it's on its own little bearish trend right now, kind of falling in line with what crude oil is doing with the strengthening dollar. But again, how temporary is this? The last intermediate low point is right around this area as well. So the question is, is this also trying to set its own low point? Here's the Heikin-Ashi candle. That's a relatively bearish candle and suggests that there might be some more downside here to the yield. Of course, any downside in yield and in crude oil for that matter as well, as you can see, it's a pretty bearish reversal pattern that we've gotten there. Any downside in these would most likely coincide with more of an intermediate pullback in equities. So that might be, kind of keep an eye on that as other signs that this intermediate pullback may be in the beginning process here. Remember, it takes a couple of weeks of these kind of smaller candles to form. If you take a look at the Russell, we already have one, right? We're not going to close above that high point this week, and most likely not going to close above that high point next week. So the Russell's got a pretty significant high that's going to be hard for us to clear, which suggests that we can get some sideways action here and eventually a transition candle to the downside. And we're seeing some signs of that, like I said, in other asset classes too. If you take a look at some of these emerging or the international equities, emerging markets have reversed or showing a reversal pattern, and developed markets are in the process of a transition. So they might be leading us towards, again, another signs that this intermediate pullback process might be in the early stages right now. Again, takes a week or two for things to really start to converge. So the SPX is just in that process, still very strongly bullish, but we're seeing signs that we're in that process, that we're in the early stages of that process. Keep in mind, from Nichimoku Cloud standpoint, the daily chart, you can see the bearish trend is getting pretty strong. It's gotten below 2 and above 65 on there. That's a pretty strong trend. And then when you look at the 10-year note, you can also see too that we've been pretty bullish, but unable to really get going. In fact, if you take a look at the long-term view, we've been in a strong bearish trend, and it looks like it's trying to renew that. And here's crude oil on that weekly chart. It's been on a relatively bullish trend, and it's given that up. And I mentioned here before as well, when you look at the DMI, the long-term DMI for these, so let's look at a weekly chart. SPX is still strongly bullish, and it's just about to turn, the shading's about to turn light green. So that's why, again, early stages of a long-term move. But if you take a look at like crude oil, then you can see its negative directional index is just starting to cross up above 20. Its positive is already below 20 and has been below 20. So that's the blue line. So it's going to be, it's crude oil is not yet on that bullish run, which you kind of need to confirm the bullish posture in equities. If you look at the Russell, you can see it's got a nice good bullish pattern there. And as I mentioned before, the dollar index, you take a look at the dollar index, it's positive, its negative index is also above 20. Despite this little bounce we've had, it's still above 20, and it's needs to get about 25 for us to really get going here. Its negative directional index is obviously below 20, so I still have a negative bias towards the dollar. We just haven't really engaged a strong trend yet in a long-term move, and obviously haven't broken the beginnings of this bearish trend yet either, to say, oh, well, forget the bearish dollar, now we're back to a bullish dollar. We're still in that bear dollar mode. You take a look at the Bollinger Bands and look at the long-term chart for like the dollar ETF, and you can see we kind of broke down and we bounced back up here to the top of this, to the bottom of the gap in the dollar, to the top of this kind of volume area. We break through there, and here we go. But if we hold that resistance, then we continue down into, slowly down into this volume area. We won't fall off a cliff, but we'll kind of grind our way towards potentially this 25 area. All right, now let's take a look at the sectors and how they performed here today. And we'll just look at just today here. You'll see that utilities has been climbing up and it's had a good run. Industrials, real estate, I mean, kind of risk off, but you notice also discretionary technology and, like I said, industrials outperforming. So not a complete risk off day, which is, you wouldn't expect it to be anyway. Some of your cyclical areas down here, healthcare especially, has been an outperformer. In fact, if you look at the last 3 months here, healthcare, communication services, financials had been an outperformer. Industrials has been lagging behind. It bounced up. Utility, look at the move that utilities and real estate have made over this last little bit. They've really rallied pretty much since January the 8th time frame. If you look at since the January the 8th till now, and we'll go to like an hourly chart. You can see utilities are up 7%, real estate's up 5.25%, technology's up 6%. So, and staples. So I mean that's kind of a risk-off trade. We look at energy, especially, really dropping down 6%. Materials, industrials, financials, discretionary, all these cyclical areas all lagging behind the market. And just to kind of give you an idea of what the markets look like since, well, here, go back. Let's do the asset class out comparison too. And we'll do this since January the 8th and go to an hourly chart. Here we go. You can see real estate. Look at long-term bonds up here with stocks. Look at crude oil is down 11% in this period. The dollar's been up. Small caps have been lagging behind large caps with their returns. So, and again, to show you what it looks like here, here is January the 8th right there. So the stock market, the S&P 500 has done that since January the 8th. So it's been kind of a risk-off move, even though the S&P 500's been up. So kind of keep an eye on that in terms of signs of weakness. Like I said, that this intermediate pullback process has started. We haven't really started to fall off a cliff, and that's not how the market works. It doesn't always go up or always go down, but you can see how the process has started. So in today's trade idea, in today's Market Outlook live session, I talked quite a bit about how our trade, we've had some really good trades that have been working here lately, and we've been kind of managing all of them. Closed out one of our best trades that we've had. We've been in since really September in today's live video as well. But today's trade kind of follows the same note, but we're not nearly as directional. We're getting less directional as the market's been going up. A lot of these trades we put on were back in here, at least these February expiration trades, and we've been doing well on them during this rally. But if you take a look at one stock in particular that had a bounce back today, and that's Netflix, after pulling back towards this moving average after its earnings, bounced up and then some. And by the time we got into it, it still went up even more after we got into it today with our Market Outlook Live. And finally, you can also see too, if I zoom out, you've got this 23% retracement. We pulled back down in here, got to the 78, we bounced back up, and looking like we're starting to make a run back to the upside. If you look at its Bollinger Bands, here we go, Bollinger Bands. You can see how we've kind of cleared this little area of resistance, and we're working our way to the upside using that as now a support level. You look at its DMI indicators for Netflix, and you can see the positive. You know, we were in a good strong trend. We had pulled back here, and we bounced right back up, bounced right back above 25 for the positive index, right back below 20 for the negative index. And you take a look too at the what was it, the the long-term chart here, and you can see that we're just barely getting a golden cross on Netflix. So there's some potential here to the upside. We just haven't broken through that 350 area yet, gotten really close. So instead of looking for a directional trade, knowing that we got some pretty decent support below us, what we decided to do instead was come down here and say, okay, let's sell the 335 and buy the 330 and try to get, it's a little widespread now in the after hours, and it's a relatively widespread to begin with because of how expensive the stock is. But so keep that in mind when you're looking at the pricing for this, and you get at least $1.16. I think we ended up with $1.40 when we got filled in on the live trade video. And the idea being, as long as we stay above 335. In fact, if you look at the intraday chart, you see that 335 level. There's a pretty decent support here. It has to break through the point of control, and now granted, it can easily fall back down towards this 340 area because that's where the volume support is. Point of control right below that at 337, and then another strong volume node right below 335 that can help hold you up, and as well as the midpoint of this 4-week range that we've got. So lots of support on an intraday basis that keep us up above 335, which is all we care about. If it keeps going up, great, we can get out early. Otherwise, stays above 335. That's what we want to see. So that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link to go to our Market Scholars forums, and let's keep this conversation going. Open up any new threads with any questions or comments you have about anything we discussed in the video today, as well as anything we didn't discuss that can keep this conversation going. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Follow me on Twitter for more content. Join our Market Outlook community group on Facebook. Have a great rest of your Thursday evening, everybody, and we'll see you all next time.